You find yourself 41 pages deep into a credit stress model when the phone rings. It's a Tuesday, and you're surrounded by fluorescent lights, stale coffee, and the constant whir of servers. As a senior credit analyst, you possess the insight to identify risks, yet you lack the authority to take action. Your current task involves an ordinary audit of Harville Bank Corp., a family-owned institution managing $4.2 billion in assets. It's the type of place where the branch manager knows each customer personally. You have been in this role for 11 years, known for being meticulous and reliable, but not much else. The call comes from a lawyer named Whitmore, who conveys a message laden with bad news. Your maternal uncle has passed away. This is a man you interacted with only 4 times throughout your life, a person who kept his financial opinions to himself. You hardly remember his face. According to a trust established 17 years prior, you inherit a controlling 53% stake in the bank. You set your pen down, struck speechless, the screen before you stands still. The situation is dire. The estate lacks liquidity, the stock isn't publicly traded, and no exit strategy exists. There is no co-inheritor or buyout clause, just you and the bank. In 9 days, a board meeting awaits, and your presence is required. As the call ends, you stare blankly at the model on your screen before closing it. Over the next 6 days, you conduct the most exhaustive due diligence in your career, scrutinizing every filing, regulatory review, and quarterly report from the last 8 years. What you uncover isn't catastrophic, but it is far from healthy. 31% of the commercial loan portfolio is linked to a single, declining real estate sector. The Tier 1 capital stands at 8.4%. Technically compliant, but the safety net is precariously thin. Deposit growth has stagnated, and the bank's technology lags a decade behind. A complete overhaul is necessary. There is a $340 million loan portfolio your uncle deemed to be performing, but you have doubts. Then you discover a $60 million line of credit, nearly fully drawn, which leads back through 2 shell companies to the bank's longest-serving board member. Reading through that document, it becomes clear what you're facing. With your extensive experience, you recognize the weight of its implications. The pressing question before you is how to act, report to the regulator, or handle the matter internally. Each route carries significant consequences. You realize these decisions aren't merely ethical, they are strategic, and you must navigate them alone. At the board meeting, you don your well-tailored suit, say little, and choose instead to listen. You are now part of the system. Meanwhile, that stress model is still open on another screen. Within 30 days, you engage outside counsel specialized in bank governance. You proceed discreetly and quickly, initiating a comprehensive, independent review of the commercial loan portfolio presented as a routine post-succession audit. You have one private discussion with the board member associated with the holding company. The exchange is calm and unhurried, leaving no doubt as to your knowledge. He resigns 2 weeks later, citing health issues. The $47 million line is placed on watch status, and no regulators are alerted. You have made this decision intentionally. Protecting the institution safeguards your position. This choice will haunt you for years. You will question its morality, but will not alter it. The credit review reveals worse outcomes than anticipated. $218 million reclassed as substandard, with 3 loans shifted to non-accrual status. Tier 1 capital now sits at 7.1%. You bear the weight of responsibility for $2.9 billion in deposits, a staggering 84,000 customers who remain unaware of the situation. Sleep eludes you. The burden lingers through the night. To tackle the capital issue, you have 2 options. Increase equity, which would dilute holdings, or reduce the balance sheet. You elect a hybrid approach. One outside investor acquires a 12% stake, injecting $85 million in fresh capital without gaining a board seat or operational control. You retain the majority and make all critical decisions. As Tier 1 capital rises to 9.2%, the once watchful regulators quiet down. You've purchased yourself time, vowing to maximize every moment. You promptly recruit a new chief credit officer who has navigated a full credit cycle before, and establish an internal credit committee endowed with genuine authority to question any lending decisions. You terminate 3 senior loan officers whose approval processes were based on connections rather than numbers. One has been at the bank for over a decade and weeps as you guide them out. You provide a fair severance package, but restrict yourself from emotional excess. You're evolving into someone who distinguishes between difficulty and wrongdoing. These are not synonymous. By the 9th month, the non-accrual portfolio begins to reduce. The loan book is gradually becoming structurally sound. Although the bank isn't currently expanding, it is transforming into an institution poised for growth. Your thoughts begin to shift toward the bank's potential rather than its past. This new mindset is significant. 18 months in, you pursue your first acquisition, a community bank located 40 miles north of the city with 680 million in assets. It's well-managed and deposit-rich. The owner seeks to exit without a succession plan, listing the price at 92 million. You finalize the deal at 88 million with cash, stock, and a subordinated debt issuance. The regulators approve it within 4 months, and you surpass the $5 billion threshold in total assets. This figure carries weight, ushering in enhanced requirements, intensified stress testing, and increased scrutiny. You don't wait for the oversight. You hire and build to meet it. You're not merely managing a bank, you're constructing one. The distinction is substantial. Your focus has shifted from individual loans to entire portfolios, marking a fundamental change in perspective. You have transitioned from merely reacting to problems to actively designing conditions to minimize their emergence. You operate at an elevated level now, feeling not distant from your work, but in command of it. At 5.4 billion in assets, you grasp the true potential of a banking charter. You originate loans and sell them in the secondary market, earning fee income while effectively managing your exposure. Your services expand to treasury offerings for municipalities, and you engage in syndicated loans, allowing you to oversee risk without holding all of it. Every dollar of assets yields a return that silently compounds, operating outside the conventional flow of salary or bonuses. You recall your uncle, who controlled 4.2 billion, choosing silence towards you for 40 years. That silence has transformed in your mind. It no longer feels unkind. 3 years pass, and the regional economy presents precisely the scenario your models anticipated yet hoped to avoid. Interest rates rise faster than expected, causing commercial real estate, a sector that had been recovering, to falter and subsequently reverse. Two prominent borrowers signal early signs of distress, with combined loan exposure totaling $74 million. While not critical, the situation isn't comfortable. You must act before it escalates into one or the other, with no time to lose. You can either collaborate with the borrowers, extend maturities, restructure the debt, and absorb the costs over 14 months, or you can call in the loans, force liquidation, and take the losses now, maintaining a spotless balance sheet. Although liquidation is a quicker route, it devastates businesses and harms the employees involved. After careful calculation, you select the workout path, not out of sentimentality, but because it presents a lower expected loss. In a quieter moment, you recognize this as the first time in 3 years you've experienced a semblance of mercy. Whether the calculation preceded the compassion, you choose not to scrutinize too closely. The workout lasts 14 months, with final losses culminating at $14.3 million. Your models hold firm, and when the next quarterly review arrives, your credit officers exchange glances that say it all: we built for this. By year 4, the bank boasts 6.8 billion in assets, with net income reaching $94 million. Your equity stake is now valued between 380 and 420 million privately. Yet you have not sold a single share, nor drawn a salary exceeding $600,000, not once. The entire situation is fundamentally structural. It involves retained earnings, capital ratios, and an institution utilizing other people's funds. Now you see why your relative chose to live so discreetly. The figure has no correlation with everyday life. It exists solely on paper, abstract and stable, completely reliant on a bank that could still face a liquidity crisis. You never disclose that figure to anyone, not even to those close to you or in approximate ranges. It remains a secret. In the 5th year, a larger financial institution approaches you, a regional entity worth $40 billion, publicly traded and rapidly growing. They want your bank, Harville, offering $680 million for your controlling stake, without any conditions tied to the deal. This values the entire bank at over $1.2 billion. The offer is straightforward, without any earnout or operational role associated. Accept the cash and walk away, leaving credit risk behind forever. You contemplate this offer for 3 complete weeks, not telling a soul about its existence, and ultimately reject it. The reasons you have are a mix of financial and emotional factors. Both play a significant role. You have dedicated 5 years to build something that serves as infrastructure, a resource that communities genuinely rely on. Selling would mean shifting decisions to individuals whose interests do not align with those of your bank's clients. You have witnessed the process of integration post-acquisition from within. You know what aspects typically get cut. You decline, fully aware that this choice might cost you $300 million in liquid assets, a loss you can never recover. Regardless, you choose this path. You are uncertain if it is the right one, but it's a decision you must make alone. Then in the 6th year, an unforeseen event occurs that you could not have anticipated or prepared for. It doesn't reveal itself ahead of time. A competitor bank holding assets worth $2.1 billion fails its stress test. The FDIC starts a discreet resolution process, searching for a buyer. Your bank is among the shortlisted candidates. You have 18 days to act. Acquiring the bank would bring your assets close to $9 billion and cross another significant regulatory threshold. However, if you act swiftly, the purchase price would fall below the bank's total book value. The calculations are straightforward. You initiate full due diligence early in the morning. By noon, 22 analysts are deep into the data room. By day 3, you have determined your offer. You know precisely what you will pay and what aspects you will write off. On day 7, you place your bid. By day 12, the FDIC responds with a counteroffer, which you reply to the same day. On day 15, you finalize the deal. Harville Bank Corporation now holds total assets of $8.7 billion. You have not appeared on any lists or given any public interviews. Externally, nobody is aware of these developments. However, within the circles observing balance sheet expansions and acquisition rates, your name is now recognized. The calls begin to pour in. Partnerships, deals, political appointments, and a $400 million relationship with the state treasury. A private equity firm reaches out, possessing a troubled credit portfolio and seeking you as their banking partner. You selectively respond to these inquiries. The most critical skill at this stage is knowing when to withhold capital. Do not deploy it recklessly. Your influence is potent, even if it doesn't manifest outwardly. There is nothing overtly visible about your power. No formal titles, no public authority, just a solid balance sheet and a bank that avoids drawing attention. In your region, very few commercial activities proceed without involving your bank at some stage. This evening, a credit committee report is awaiting your attention. There's always something that needs your focus. 3 more commercial loans exhibit early signs of stress. The rate environment has not settled as your projections anticipated. A board member is inquiring, both politely and with persistence, about your succession strategy. He will continue asking until he receives a satisfactory answer. You are 44, having led this institution for 6 years. The fatigue is different from what you had expected, not from the workload itself, but from the awareness of how many factors must align perfectly for stability. The balance sheet is in good shape. Capital is sufficient. You have assembled the best management team you have ever had. Yet, none of this guarantees safety if a wrong sequence of events unfolds on an unfortunate Tuesday. You are acutely aware of this. You close the credit report before reluctantly reopening it. One loan demands your attention tonight. $38 million for a warehouse distribution company, where leverage exceeds 5 times. Covenant headroom has been decreasing steadily every quarter. The credit officer suggests a waiver and a 90-day review. You are uncertain if you agree with his assessment. You have seen this scenario before. Recognize the decline's trajectory. You know where it leads. Previously, a pattern like this resulted in a workout arrangement, ultimately becoming a loss. So, you set this aside for the moment, deciding to revisit it in the morning when your judgment is sharper, not now. The market is already in motion without your involvement. Tokyo has opened, Shanghai is trading, night carries its own reasoning. During the overnight session, capital is shifting in unpredictable ways, reaching your desk by morning. Each night, you did not create these forces. You cannot halt them. All you can do is construct an institution capable of absorbing whatever comes next. You built a bank or transformed an inherited one into a functional entity. The distinction between the two fades. It is less significant than it seemed on the first Tuesday you confronted. Everything feels simultaneously less and more significant. The calls will resume tomorrow, and the decisions will remain consequential. They are always consequential now. Every single one influences businesses, employees, and the gradual mathematics of regional economic ecosystems. You will strive to make the best decisions possible with the information you possess. Some choices will turn out to be incorrect. The wrong decisions may cost you funds that are manageable or ones that are not. You will learn the outcome when it arrives. Then, you will confront a challenge faced by anyone who has ever managed a financial institution. The moment when the institution surpasses you. When the balance sheet assumes its own logic and will, when the market issues verdicts without seeking your input. It has never done so and likely never will. You do not fear this moment. You have been preparing for it since that initial Tuesday. Yet you're not truly ready for it. No one ever is. This reality is never mentioned in any official filings. The clock shows 11:47. Markets will open in 6 hours. You return to your work. You always do. Before I say goodbye, remember to subscribe to Billy Finance. Feel free to leave your comments below.